its largest point gain ever yesterday, up 2,100 plus points. Joining us right now over the phones is the president of Pomboy May. She's Stephanie Pomboy, who really called a sell-off a long time ago when we were in real boom times, and that was because of the debt in the corporate sector. Corporate leverage was one of her big issues, and she's on the phone right now. Stephanie, good to have you this morning. Give us your assessment of what we've seen in markets this last couple of days.
Well, actually, you probably fall out of your chair hearing me say this, but on Monday, after spending the weekend, watching the news and on Twitter and, reading all the headlines, I felt like we had reached peak hysteria, and I actually bought calls and, was able to catch that rally yesterday. I anticipate we may have a couple days, maybe a week of this kind of feeling that things are better. We got the stimulus finally passed. And we at least have a handle on, where we're going with the coronavirus and some promising treatments. So I did feel like we were perhaps oversold and that people were getting overly hysterical about it, not in any way to diminish the, importance and the urgency of the problem. But I think that after this sort of intervening phase where the market maybe recovers some footing and people start to kind of step back and, have a little bit more of a cool-headed reaction, we're going to have to deal with the second part of this, and that is, with the coronavirus issue is one thing. The longer-term, bigger issue we'll face is exactly what you mentioned in the intro, and that is that we have now burst the corporate credit bubble, and, try though the Fed may, it just cannot put the air back in there. I think, you and Rudy were talking about how people's behavior will change after the coronavirus in terms of, hand washing and reluctance to go to gyms and get on airplanes and that kind of thing. And I think that's true. There will also be, importantly, a shift in the behavior of companies and consumers, households, after this whole experience, because people will now realize we can't run our businesses with zero inventory, zero cash, zero preparation for any kind of exogenous event like this. So, this was the legacy of the Fed's whole quantitative easing interest, repressive interest rate regime for the last decade, is that it punished holding cash and holding inventory. You should just go out in the credit markets, tap as much cheap credit as you can, enrich shareholders by buying back shares and paying dividends, and not worry about saving for a rainy day that was never going to come. And I think we've learned that lesson powerfully, and that's going to change the behavior of companies when we come out the other side of this. So I don't think forecasts for a V-shaped recovery are really realistic.
Right. Well, because that takes time. Let me bring Allie McCartney from UBS right here. She's on the panel this morning. Allie.
So Stephanie, you made some great points, and I'm interested in the fact that you are buying calls, or that means that you expect some upside appreciation in the near term. You talked about a V-shaped recovery, and there seems to be this obsession in the financial media with talking about the shape of the recovery. Obviously, if you're a short-term investor, the shape is important. But can you talk about, for long-term investors, what you are thinking now and how you would make that investment back into the market?
Well, I guess, importantly, my bet on a recovery in the market is an extremely short-term trading opportunity. It's not something, I'm just throwing that out to underscore that I do think we're going to have a period here where people kind of take a step back and exhale and, factor in that the stimulus has now, been put in the system, both monetary and fiscal. But again, I don't think this is going to be...
You also have to remember that valuations are an issue, right? I mean, we were down 37% from the high. So is that also a reason to take a breath and say, okay, well, maybe I want to find opportunities here? I mean, you see some of these companies where they're trading with really strong balance sheets.
Yeah, I mean, I guess you'd have to go on a company-by-company basis, which isn't really what I do. I just look sort of at the broader market. And I come back to this idea that we're going to have a major shift in behavior, just like households change their housing bubble bust, and for years were very reluctant to borrow again in any manner, credit cards, autos, whatever. And they, really evinced a impulse to save after the housing bubble bust. I mean, we've seen, until recently, despite record inflation in financial assets, the household saving rate continued to move up, which was unprecedented. And I think you'll see something like that happen in the corporate sector after this all settles down, where corporations say, first off, this wisdom of having global supply chains is clearly being called into question. So we've got to, source our inventories closer to home. We want to hold more inventory. We want to husband cash. And all of that comes at the expense of, spending on production, shareholder buybacks, whatever. And that's going to be a restraint on economic activity in general. I'm not saying it's, the end of the world. It's just going to be that new normal, quote unquote, that will, at the margin, depress activity. So as relates to a V-shaped rebound, sure, mathematically, after, we have down 20 or 30% growth, we'll have a mathematical rebound. But I don't anticipate that we'll continue to move sharply higher. I think we'll go back to a new normal level that will be a slower rate of growth than we saw going into this episode.
Right, I see. Dagan.
Hey, Stephanie, real quick question. And by the way, you pointed out in terms of balance sheets, these balance sheets get turned upside down if a business is shut down for a month or two. The top 3 companies have more cash than the bottom 400 companies in the S&P 500, to quote you. But in terms of investment-grade corporate debt, many individual investors have gotten burned, even in short-term investment-grade mutual funds and ETFs, where in a day they had 2 years of yield wiped out. Serious dislocations. Of course, the Federal Reserve intervening in several ways into that market. But should investors try to get themselves out of those positions just because of the uncertainty, number one? And number two, what about in TIPS, Treasury inflation protected securities, given this massive stimulus that's going in, could those do well long run?
So as to the first one, with the Fed standing there buying, being the backstop for investment grade debt, I mean, I guess you could take the opportunity to try to get yourself out while the getting's good, so to speak. I think, what's really going to be interesting to watch is what happens as the downgrade wave happens. There's an article in the journal today about how S&P and the other ratings agencies are now catching up, and they're starting to downgrade a lot of paper, including paper that was actually rated AAA. So as that hits and some of those investment grade bonds actually fall into the junk category, you're going to have a whole new problem on your hands, because the Fed isn't buying any of the junk rated paper. So I think that factor will have a negative impact on all manner of credit, across the credit rating spectrum. It's pretty rare for junk to trade really distressed and to not have any kind of ripple effect on higher quality credit.
Yeah.
As relates to TIPS, sorry.
Go ahead, Stephanie. Quick. Then I want to get Allie in once more. Go ahead, Stephanie.
Okay. On TIPS, I guess, I see long-term the potential for inflation with this massive monetary injection. But I think right now the forces of deflation with the deleveraging of corporate balance sheets and a weaker economy are going to overwhelm any ability to pass on higher prices.
Go ahead, Allie.
I would like to highlight something that's been sort of touched on all morning, and Stephanie, that you really just brought home, which is a lot of what we've seen since the financial crisis is what we call indiscriminate buying. So buying all of investment grade, buying all of telecom, buying all of the S&P. And a lot of that has become doable and accessible to especially the retail community through ETFization or sort of all these access vehicles. One of the things that I personally will be doing differently, talking about changes to behavior in the future, is as opposed to buying the entirety of the S&P 500 and saying, look, it's been really difficult to beat that, I'm going to be buying managers and stocks and management teams and individual companies and dissecting their balance sheets. And I'm going to be taking that same discipline and I'm going to be applying it to the municipal market. I'm going to be applying it to the high yield market. I'm going to be applying it to private equity. And so this concept of indiscriminate on the way down, but very specific and rewarding companies on the way up, a la what happened to Nike in the last 24 hours as they provided guidance when other companies can't. I think that is very, very important and is going to continue to be important over the months and maybe years as the globe adapts to what we've been dealing with.
Say hallelujah, Allie, because what you're saying is we're going to go back to doing genuine research and analysis rather than just assuming that everything is always and forever going to go up. So I welcome that day when we get back to doing research.
Stephanie, do you believe we are going to see a bounce back at the end of the year? Because you've got James Bullard out there saying that the third quarter will be strong, fourth quarter will be a very strong rebound, and the first quarter of 2021 as well. Stevie Mnuchin on this program saying we're going to have a gigantic fourth quarter in terms of a rebound. How much confidence do you have in a pretty good rebound once we do see a snapback and the coronavirus fears are gone?
Well, I guess the question is really what's the sustainability? Is it just a one quarter pent-up demand, we just get back what we had lost, or does it continue to then have some asymptotic rise higher? And I would argue that we have just a quick sort of dead cat bounce, and then we revert to a new lower level of sort of lower trajectory for growth. If we were running at, let's say, 2.5% growth last year, we'll probably run at 1.5% growth. That'll be our new normal level. I do think mathematically you're going to have a rebound, but the question is what's the follow-through, and I don't expect that the follow-through is going to be anywhere near what Wall Street and everyone else is currently expecting.
And one of those tools in terms of growth is a metric called durable goods that we look at. Durable goods is out. We were expecting a big decline, 0.8%. Let's get to Lauren. She's got the number right now because I think it's better than expected. Lauren's been
this is surprising, Maria. And take a look at how the markets do react to this. The Dow is positive. So you were right. For February, orders for those big ticket expensive items, they were expected to fall by 0.8%, and they rose. They rose by 1.2%. This is in the month of February. When we look at this number, we were expecting to see possibly some supply chain disruption or decrease in demand, but we got a surprise increase in these durable goods. However, when you look at business investment, how do they feel about things? Are non-defense capital orders, are they placing them? And the answer is no. That number was expected to fall, but it did fall more than we thought, down last month by 0.8%. And then if you look at ex-transports, that number also fell more than expected, coming in at negative 0.6%. So surprise increase in the headline number, Dow positive 34 points now on this news. Maria, back to you.
Yeah, I mean, we did see a bit of a strengthening as you were reading the numbers, Lauren. It is obviously better than expected. I want to get the panel's take on this because we haven't heard from you, Cabot Phillips, in terms of this economy. It's anybody's guess what happens once the coronavirus ends and we are back to normal, but certainly we are going to see the numbers worsen before they get better. What that means going into the election is also a question people are asking, certainly. Cabot.
Yeah, I think it's easy to forget about the 2020 race in the midst of all this, but it is still going on. And at the start of all this, it was easy to think that Joe Biden, this would benefit the Democrat Party because Joe Biden on the campaign trail is a mishap waiting to happen, and kind of the idea that he would get to lay low for a bit would be good. I actually think it's turned into a negative now. People have really forgotten about Joe Biden, who is the presumptive nominee. He's gone completely radio silent. Yesterday, people kind of asking, where is Joe Biden? He came out, did a few interviews, did not give this strong air. And at a time when Americans are hungry for leadership, they are hungry for someone to be that person they can rally around, President Trump has been at the podium every day. He's more visible than he's ever been. And for a lot of Americans, it's the first time they've seen him in that capacity. And so I do think that this has been a win politically recently for President Trump. Obviously, you don't want to talk about politics at a time like this, but you can't forget about the election. And I think that Joe Biden's silence actually has been a tough thing for his campaign and for the Democrat Party because he seems kind of absent.
One issue I just quickly want to raise with Liberty University has decided to let up to 5,000 students back on campus in Lynchburg, Virginia. It's causing a lot of outrage. Jerry Falwell Jr. is saying that the health inspectors have been in, that the campus is fine, okay, in the face of the coronavirus. But I'll point out that the issue is, are these students going to then be quarantined? Where are they coming from? People in the community want to know that. Are they coming from the New York metro area? Because again, 14-day quarantine suggested by the White House for that. There are a lot of questions that need to be answered by decisions like this, particularly for the elderly people and the at-risk individuals who live in Lynchburg and the surrounding area, just like my 83-year-old dad who shops across the road from the Liberty University campus. If the students come into the city and then go into those stores, they put potentially healthy students but asymptomatic, put people like my father at risk. Lots of questions that need to be answered from Jerry Falwell Jr. and Liberty University.
And that is why today we're hearing Dr. Burke say if you were even near anywhere in New York, if you were in New York, you need to self-quarantine. So sending them back to university so soon after is certainly something that needs to be scrutinized. Joining us right now on the telephone is the co-founder of Home Depot, Ken Langone, is the founder